Okay. I thought I was streaming, but OBS did something weird where I had to hit go live. I don't know how many of you watching know what that's all about or have had that in your life. But anyways, I'm sorry. I thought I was going live for about 4 minutes now, maybe three. I was a couple minutes late, but I am here now and I'm trying to repeat everything I just said, I believe. And hopefully I'm not just sound like a fool and I was actually live the whole time. But anyways, I think there's a leaf blower behind me in the background. Um, sorry, I'm just checking, make sure everything's running. And I think you can't hear it, but let me know if you do. Also, I have a heater on right now. I'm gonna turn it off in a minute. Also, I don't think you can hear it. I don't show it showing up on the sound. But you might. So, that is my disclosure for the day. On top of, I am not a financial advisor. But I would love to help you guys learn as best I can and share all my knowledge with you guys. So, hope your day is going well. Hope you're staying happy and healthy. And today is going to get pretty volatile soon at 11. I believe the actual notes are released. And then we'll try to find somewhere quick to pull those up. And then I think Jerome will start talking a little bit later. I already have his stream ready, I believe. Let's just make sure it's still up and at 'em. But yeah, the market is already showing signs of volatility. Volume at 17 million. So nothing too crazy so far. And over here on the right hand side, take a look at these stocks. If you guys want me to swap any of these out for something, let me know. I'll be happy to add something that you want to watch on there too. It's no problem. There's not one that's too important. Of course, there are, more important than others, but I can always pick one to pull off. Like Tesla might be the first one I'd pull off because it's usually, not too much of a sign of what the market's gonna do. Sometimes it'll kind of do its own thing. But that's why I like to watch them all because once they're all kind of running together, gives you a better idea of what the overall market's gonna do. So yeah, pretty crazy what will happen today. I don't know. Whether it's gonna be a 0.25 or a 0.50. Not sure. 50 points is kind of what I'm leaning toward, but his history says 25 and 50 would be a little more aggressive. So I don't know if 50 might make the market kind of pull back and 25 it might start to run. I don't know. Those are just kind of my thoughts and based off of not just, random guessing, but from what I've judged from the overall market and people that are well educated. But just know if you follow one analyst too close, you'll find out that there isn't one person smarter than the market. Man, the market will do what it wants to do. Just ask Jim Cramer. That man knows. So yeah, I'm gonna be quiet for just 2 seconds. I want to see if the sound is showing up in the background. I think we're good. I think we're good. Sound levels look good. Let me just pull this over and make sure I can see everything here. A little condensed down below. So bouncing off the 200 moving average on the 1 minute chart. Now if we look at the 15, it'll give us a little better idea. Again, it's 200 on the 15, so um, we are on support right here. If it breaks through that, I'd watch for some strong moves to the downside. 555 looks like a decent level of support. And again, if you continue on, the solid numbers, 550. But really it came all the way down to 549 right there. So there is lots of room to run in either direction. So just wait for that move and try to ride that wave. I'm starting a small account challenge today with options, $10.01. And let's see what I mean, volatility is up today. It looks like it popped this morning and pulled back a little, so it's not going to be easy. And I will definitely warn you guys, good chance this doesn't go well, especially on FOMC day. So I would not recommend following this. This is a high risk, high reward situation. And really, I'll wait for the market to start moving. I want to give it a little bit of time and see if a trend will build, rather than trying to predict the future and getting screwed. Because, like I said, if you were to get into some long-term plays yesterday, VIX was pretty low, to where you could come out on top on either side, as long as VIX continues. But yeah, so that's what we're looking at right now. Nothing really catching my eye, and again, not really predicting either way. It's basically chopped around from yesterday. So just a little bit less action, chopped around within that gap range, which is pretty expected. Oftentimes when you see a gap like this, you'll see, frequent price action in that area. Because there is less volume traded right there, you'll see those bigger moves intraday when those gaps happen, after hours. Okay, excuse me. I am battling a cold or something. Luckily, you can't pass colds through YouTube. So looking for not that direction. Let's see if there's anything up so far on the Fed site. 2:30 Eastern time. So I don't know if this will even go live until 11:30. We shall see. I don't know. I was thinking about checking over on maybe someone else's channel. I don't know how I feel about that completely, but usually for something like this, I might just throw on like Meet Kevin, see what he has to say, and it just makes it easy to kind of follow along. So I don't know, let me know or not. Maybe I'll just go over there and peekaboo. But sometimes he'll have those minutes up right at 11, and he's also a great source. If you guys never heard of him, I think he's certified in a lot of that sort of thing. So. Let me take a look down below. Let's just go back over here while we get ready. 3 minutes till they're released. And I'm going to try to look down below. I was thinking about putting music on, but I don't know. I mean, it's going to demonetize me, but at the same time, I would like to have some fun. So if you guys have a music recommendation, throw them down there. I'll think about it. I'm not going to guarantee I'll play anything right now, but try not to get me demonetized. Or flagged, most importantly. I have a keyboard, yet I'm over here using my laptop. Stupid. Um, okay, so right now I'm looking at. Oh, come on. Pull this up here. Aha. $2024 meetings. February, April, May, August, September. So I believe it should update right here. Now, I could be wrong. I've certainly never tried to do this live, so if I look like a fool live, that's just great. Just great. But it is what it is. I Now I swear that leaf blower is getting louder behind me. If no one can hear that, that is just a real compliment to technology. Turn this heater off too. Hopefully I don't get cold. It is 62 degrees in this room right now, so I'm immediately colder. So yeah, I think this should update any second. Let's see if that was weird. Not sure if you guys heard that top step just closed and reopened right at 11. I've never heard it do that. I don't know if that's something about today. Here it is. PDF. In conjunction with the FOMC meeting held on, meeting participants submitted their projections. I mean, let's just get to the numbers, right? Let me zoom in here. Um, wow, it just got dead silent. I think it finally stopped. Can hear my brain trying to function right now. June. What am I not seeing here? I'm not good at reading this. I'm not gonna lie to you guys. Let's get these numbers. Let's see how the market's reacting. Holy crap. Very, very bullish. Oh my God. So careful right here. If you're looking at this trying to chase, it could reverse just as quick. But again, all-time highs almost immediately. Let's look at the 1 minute chart. Thing is ripping the whole market going off. Going off. Come on. So watch this. Extreme volatility. VIX didn't move much though, which is kind of surprising. And if you're holding something right now, and if you're holding a call right now, congratulations. That thing went up. Be ready to take profit though. So as you can see right here on the 15-second chart, it could come back down, but we shall see. So let me try to pull this up on my phone while I'm trying to multitask here. This is definitely the first of many of these, so we'll see how time progresses. They can only get better. All right. All right, 50 basis points in the first rate cut since March 2020. Wow. Pretty crazy. So actually we can go over to no, I don't want to take up the screen. So let's try to keep our eyes on the screen, eyes on the prize. Watch for this trend, and I believe Jerome Powell will be speaking soon. So let me try to get that ready at the same time. Pretty crazy, 50 points. That is where I was leaning, but it was hard to guess. Very hard to guess. But the market likes that. That's good. Hopefully it doesn't draw us into a recession, which I don't think it will. I think the economy has proven over the last few years that that's not going to be the case. So let's just take a look at the contracts right now. Now with $10, what are the options? Not many, right? That's very difficult. And again, I wouldn't even recommend starting a small account challenge on FOMC day. Very risky. But here's the order book, and this is kind of how I'd watch it. Take a look at those $7 576 calls, and the way I would do this is try to get in and out as soon as possible. And I would rather wait right now though, see how it handles this. So maybe I'll move these alerts around. It's gonna be so volatile that it's better just to watch because it could go in and out very fast within a $5 price range. Popped from 563 to 568. Crazy. And so yeah, right now pulling back. See how much it pulls back. It can completely reverse. Would not be the first time that I've seen the reversal like that. Let's go back over here. I'm all turned around. I don't think this is up yet. No. Nope. All right. I'm going to actually pull this down here. Could take a look at this Kobesi letter account really quick too. Very informative, but I'm not trying to take my eyes off of here. I really need a third monitor, clearly. So this contract dropped all the way to 5 already. So again, definitely why I would be very careful in this situation. Watch for support. Wait for that trend to play out before you just dive right in and take on that risk because many accounts are blown and made on this day. It's a very aggressive day to trade. So I feel like I'm fighting a sneeze. So if I'm making weird faces, you know why. All right. So it's already back. No, that's not the same one. So now the 575 calls have already dropped to 7. So it's good to pick a contract that's kind of within your budget or your price range based on your account size and just watch it for a while. Don't make impulsive decisions. That's one of the things I would say to keep in mind the most. Make thought out decisions and don't do it right away. Pick a contract, watch it. Hey, you might miss a move, you might not. You might learn that if you would have chased it, you would have been faked out and then lost money, and it's better to just watch it play out. So, as you get used to it, it gets easier. But again, on days like this, it's so unpredictable that just be careful. This is the, I'm assuming this is not, this is the FOMC meeting right now, but there's no picture. It's kind of creepy. It stopped. Wait, it went. Why'd it stop? I guess you have to be on it still. I don't like that. I don't like those vibes. Eerie vibes. Let me just try to pull something up here. Yeah, so those 575 calls now, look, they're at $9. So from 7 to 9, already decent profit. If I was holding it, I'll be ready to take profit at 8, you know. Of course, there could be a huge move to the upside, but with a small account, you really just want those base hits to add up until you could take on that bigger risk. You know, with $10, you know, $2 gain, that's 20% profit. You can't be mad about that whatsoever. Okay. Apologize. And yeah, so again, I would have took profit at 8 and I would have been out right here. But that's why it's important to watch the order book, because it can get um pretty risky if you're not paying attention. You know, you look away for a second, or even right now, I'm trying to talk and think at the same time. And it's not the easiest thing I've ever done. So a skill I'm trying to work on is live trading, getting better at narrating while making those trades. So right now, again, very, very risky, high risk, high reward. And I'm just going to make sure we're not missing anything here down below. Yeah, so it's still just chilling. The Federal Reserve. Pretty interesting though. 50 points and a nice initial pop to a sell-off. So if you would have chased this, man, you would have been frustrated. Because if you had a $50 account, for example, and you're like, yeah, let me get something around that price range, take a look at what this did. Whew. If you were holding it before the mark, okay, that's annoying. What's going on here? Ay, ay, ay. Remove. But yeah, if you're holding it before, you can see this thing went like 150% in a very short time frame. And I'm sure my face, maybe my face is a little bit in the way on this. There we go. But yeah, you can see it popped hard. But if you didn't take profit, man, you would have been regretting it. Or if you chased it up here at the top at 100 and that thing's already back down to 30. Just a good example of why to be careful. Um, Kobesi letter. Let's see what this Twitter account has to say. They're a great source of information. I recommend you follow them. If you don't, hey, I will probably always shout them out. I shouldn't say always, but let's see here. 6 minutes ago. So they do a great job, very professional, putting everything together. And I like to just kind of scroll through, give them their props and take their information because it's very good. Don't take any one source, you know. I recommend you take many sources, make your own judgments and things like that. But I want to try to do a good job also of going back and forth without missing anything here. Um, let's see. All right, so they cut it by 50 points for the first time since 2020. They see two more 25 points in 2024. So we'll see if that happens next time. And then that'd be interesting actually. If they skip one and then go for a 50, or if they do 225s, which I think makes more sense. Start off aggressive and then kind of ease into it just to get that ball rolling. I think that's what the economy really wants to see. But again, be careful trading on this day. Because even though I'm planning on trading right now, I still haven't made a trade because of how volatile it is. It would have been good maybe to short that pot, but again, still risky. I'm going to wait for a trend to play out. We still got a couple hours left in the day, and I'll try to make an options trade by like, noon or so. Let's see what happens around the time Jerome starts talking. It's, should be a lot of fun. But sometimes it doesn't get more volatile than this right here. He'll start talking and then the market just kind of chops around in this zone. So hopefully it doesn't get boring, but only time will tell. So looking over here at these other charts, let's take a look at the 15. So everything initially popped and then basically sold off back to support. So again, pulling back pretty strong here. And as the market, takes their profits and cuts their losses or whatever might have happened, cuts their shorts. A lot of that was probably short covering. Well, yeah, complete reversal. Meta selling all the way back off. We can just scroll through these. Apple made a nice pop, selling back off, but still at support for the day. Let's just look at the 5-minute on here. Scrolling out a little bit. Google, man, chasing this would have been so painful. So yeah, don't be trying to catch a falling knife or trying to jump on a moving rocket, because you're gonna pay for that one. Good morning. Is it morning? I don't usually stream this early. I guess it is morning. Good morning. 11. Almost afternoon. And I think Jerome Powell should start talking soon. So back to the Kobesi letter as it's chopping around. I don't think I'm gonna make a trade between now and when he starts talking. I want to be ready after it starts talking. Don't want to make any foolish decisions here. So Fed sees 2 more basis cuts. Let's see those full. One Fed governor descended for the first time since '05 in favor of a 25 rate cut. Fed gained greater confidence that inflation is moving to 2%. Fed will carefully assess incoming data and evolve outlook. Fed sees 100 basis points of rate cuts in 2025 and 50 in 2026. The long-awaited Fed pivot has officially begun. So hopefully we do it nice and easy, and the market continues to climb. So look, we bounced off support here. Again, I think this is around the same. Yeah, the 200 moving average on the 15-minute chart is proving strong. And the market touching all-time highs for just a moment. Let me see here. What did I do with? I lost Jerome Powell. I think I moved him to a different screen. Bouncing. So this would be a decent time to at least take the chance. Let's just take a look at these options. So right now the 574s are what I would look at with this $10 account. With the possibility of a bounce, ooh, it would have been a good chance to get in there. I like to watch the order book as long as I can and try to get on those last ones so I can get break even as soon as possible. And then you have a little bit of breathing room. But high risk, high reward right here. Very volatile. So you're gonna have to possibly sit around through some chop. Oh, come on. So again, I would have gotten in at 7, and it would be break even right now. I probably would have tried to get out immediately at 8 just to make that base hit. So another quick trade is all that would have been, which is the struggle of the small account. You have to wait for the next day for it to settle. But those base hits are important. Or you could take, the less risky approach. Or, I don't even know if it's much less risky, honestly, because this could reverse just as quick. but it's just, not as money on the table. Or $4, I've had some good trades at $4 too. As crazy as that might sound, those can run, 100 to 1,000%, quite often if the market's volatile. So keep your eye on these. Um, and VIX dropping, so that is part of the problem right now too. VIX actually straight crushed. Whoa, did it crush or did it not crush? It looked like it was at 17. Let's take a closer look. So on the 15, it pulled back to 18. So I guess it's not a full crush. It looked like it completely came back down to here. So it's just, a half pullback on it, and we'll see how much it continues. Usually the market inverses the VIX, but that's not always the case, definitely. If you use that as your one strategy, you're going to find out very quickly. So back to SPY and the 1 minute chart. There it is. Man, I don't know why they have to use that creepy music. So we are bouncing, bouncing. And let's take a look at that 574 now. Look at that. Running. So 7 would have been a decent entry. It's at 9 right now. I don't know what the exact percentage, but over 20% gain right there. Not a bad trade. Can't be complaining about a 20% profit. And locking that in. Because, yeah, it's not looking too strong, but or if you have more, you could have bought a few of those, take profit on, a couple of them, and then hold on to those runners. That's the best position to be in once you're already in profit. That way you take all the risk off the table and you're left with nothing but reward. Or if it moves more, which is, you're going to have it move more than $2. But if it does move, say $5 from 7 to 12, you can just enter a stop loss in at like $10 and it'll stop you out probably at 9, which can be frustrating if it goes all the way to 12. But that's a way to at least give yourself the chance to let it run and see how far it can go. So this right now, could have got it at 7 just a couple minutes ago, and it's about to hit 10. And also good entry right here. You could buy 8 right now. Boom. Watch that move over. Market is bouncing. So this contract up 30% from when we were looking at it a moment ago. And that would have been, good enough for me right there. So lots of opportunity in the market, no matter your account size. Of course, it is definitely going to be harder the smaller your account, no doubt about it. But the plus side of that is that it's going to build up those skills that will make you even better at trading with more money. And it will, it will really give you discipline for sure. So, market kind of chopping around now. Basically, what I would have expected. A nice pop with some chop. I would expect resistance again right here in this zone, which was also, I believe, the previous all-time highs was around 565. Let's look here. 564.39? No, 565.15. Oh my gosh, excuse me. I'm going to take a sip. All right. Feels so awkward drinking out of a straw. I think I have to say that every time. There's nothing manly about drinking out of a straw. There's no cool way to drink out of a straw. Just not a position I want to be in on camera. But I'm thirsty. So I forgot what I was saying. Let's see if this has started yet. Probably not. Not yet. All right. Not quite yet. Give it a little bit more time. Let's just keep our eyes on this 574 contract. Order book will be your best friend. If you're not paying for level 2, I recommend you spend the $3 a month to get level 2 for sure. It will change your game in trading. If you don't have level 2, you don't get to see all these different levels down here. You're just going to see 8 and 9 bid and ask. You won't be able to see how close until we're getting for it to move to that next level, which it gives me more patience, helps me get good entries, and just gives you more insight to what's really going on. Pulling back, so again, hitting resistance here. Not interested in trading. This would have been a decent time to probably get in on a put. And again, if I was in a put right now, it probably would run around the 554, I guess. 553 maybe. Depending on what it was at just a moment ago, but 553 was probably only $7 in this range right here. So that's what you'll look at if you're trading with a very small account. And if you've never traded before and you're scared to lose money, it's a great idea to start with a small account. And if you've never traded at all, start with a paper account. That way you can just kind of figure out how it works. But I recommend, trying to move over to real money as soon as you can, even if it's a small amount, because, when you make money, you feel it. When you lose money, you feel it. If it's paper, not quite as exciting. The possibilities are exciting, but, obviously making fake money is not as exciting. I've done some paper account challenges on here too, which is pretty fun. But not the same reward. I think I started with I think a $50,000 one, and I almost got it to 1 million, but I just gave up. I think it's currently still, actually, it's probably right here. I think this one I started at 50,000. This ain't it. 50,000 to 781, and then I just kind of moved on. Um, but it was fun, and it's good practice. This is Webull. This right here is Webull, but over here, when I'm doing futures, this is on Top Step X, which is using the TS Trader platform. And on the right hand side, this is the 15-minute chart, which I'll probably switch over to the 1 minute if I do make a futures trade. And right here is the Renko chart, which I just started looking at like a couple days ago. And I'm in the middle of editing a video, just a clip from the live stream, but with all the dead air and stuff taken out, where I went over how this works. But it's overall supposed to just kind of simplify things. This is the 3 minute, and it takes out a lot of the noise. But it's not going to look exactly like another chart, like a normal candlestick chart. So, this is the 3 minute candlestick. But really, if you zoom all the way out, it looks way different. Let me see here. So this would be this peak right here, but it looks like it just went straight up, straight down. But if you look on here, you can see more information, more details. The more you zoom in, you see the more details. But this was a pretty clean, pretty clean move, and it is building off support. And again, MES and ES are the same as SPY, but this is just the futures version. So if you learn how to trade SPY, if you're familiar with that chart pattern, and you want to trade futures, that's what I would recommend. It's just going over to here because it's already that pattern that you're familiar with. And yeah, and you can also, use geez, sorry. You can use all these other charts, these other big stocks to kind of guide you to and see if everything's running in the same direction. To give you an overall sense of the market. Now, I think he should be talking soon. Come on. Time is 11:25.
It's 11:25 a.m.
I don't think I said, "Hey Siri." That was creepy. Okay, they're listening to us, you guys. Siri, if you help me out, give me more impressions. Go ahead and send this notification out. If you're watching now, please smash that like button. I'm pretty sure you guys already have those, so thank you. And yeah, glad to be here. First FOMC stream, and I have an iPad that I would like to have set up to do more split screens and things, but still just trying to get this down. So I think this is a week now of me live streaming, so welcome to the week 1 anniversary. Uh, yeah. Maybe I need the elevator music. I try not to have too much dead air. I know some people are watching and listening more than watching, so I don't want to bore anyone. So trying to keep it, trying to stay classy. So looking over here at these other stocks, Meta popped. Everything basically followed that same suit. Apple still holding strong. We can zoom out here. Look at the hour chart on them. Apple with a nice cup and handle. Looking nice. Apple's also a great stock to trade with a small account. If it's moving, make sure it's on a day it's moving. There's definitely days like of course today it's moving 2% is big for Apple. Um, Not huge, but it's a decent move. But if it's on a day where it's just chopping around, this is going to be horrible. SPY's typically going to be your best bet. It's why I trade it the most because it has the most volume. And so it will give you those, the better opportunities here. If you're trading something like this, there's just much less volume. You can see right here, 9,000 volume, and these expire in 2 days. There is no same day expiration, which is another benefit to SPY. There used to only be you know, I think weekly expirations, and then they made it 3 times a week. And now every day you can just play that lotto. So these ones that expire same day, these things can run big, big money. But whether you're trading same day or one day, that's what I would recommend for a tiny account, like $10. All right. Is this man talking yet? Don't think so. Okay. Oh, we can still hear it. Can we? It's giving me Christmas vibes. I wonder what genre they were searching when they were like, all right, we need good music. So like optimistic, joyful. It would be funny if they choose something like suspenseful, make people just super anxious waiting for it. I don't think this is too loud, but it seems pretty freaking loud. Can you guys hear that? I just want to make sure you can hear when he's talking. Come on, work with me. It is so cold. If it could warm up outside again, that'd be great. It's supposed to be 69 degrees today. It's not warm enough for me. So SPY coming up on resistance as I think Jerome Powell's getting ready to talk. Yep. So let me get this ready. Don't mind my calendar and my garbage recycle alert.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand in the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year.
Market likes this.
The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile
No.
7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
I'm gonna trade futures on my phone
Restore the balance
while this is
between
up,
aggregate supply and demand,
if I see a good
easing
opportunity.
inflationary pressures, and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished, and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point.
Boom.
4.75% to 5%.
Get it out.
This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an
Is that too
appropriate
loud?
path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
Come on.
Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do. And we concluded that this was the right thing for the economy, for the people that we serve. And that's how we made our decision. So that's one question. What was the second, third?
Sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing
Still no trades for me.
that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where what the committee is thinking.
Go ahead, smash that like button.
The committee are thinking today,
Subscribe.
assuming that their particular forecasts are realized.
Pulling back. Pulling back. Let's take a look.
Chris Rugaber at Associated Press. Thank you.
Oh,
The projections show that the Fed
AMC. What the heck is AMC at? 481?
still be above
Disgrace.
estimate of long run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, and they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect in the base case to be continuing to remove
Base case.
and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So
That's what you wanted. It's crazy what they have to do is make people unemployed in order to fix this situation.
More appropriate given the progress on inflation and on employment, moving to a more sustainable
Crazy.
level. So the balance of risks are now even, and this is the beginning of that process. I mentioned the direction of
Good old quantitative tightening.
a sense of neutral, and we'll move as fast or as slow as we think is appropriate in real time. What you have is our individual accumulation of individual estimates of what that will be in the base case.
Is he saying base case? My ear's not working.
How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout.
Let's see what the volume
There
is.
was a lot of discussion.
33.
Back and forth.
It was around 17
It was also broad
when I first started streaming, so not too extreme.
So yeah, I would add though, look at the SEP. All 19 of the participants wrote down multiple cuts this year. All 19. That's a big change from June, right? 7 of the
I think that means it was overdue. I don't know.
and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance that's sort of follow the Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
We're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence in inflation.
I mean, I'm glad we went with 50.
It's coming down toward 2%.
Personally, that's what I wanted.
That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Hi, Chair Powell. Gina Smilik of the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in a solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. inflation is coming down, the labor market is in a strong pace. We want to keep it there. That's what we're doing.
Awkward silence. I get it. It's hard to fill that dead air.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical
bit.
rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay.
Okay, you son of a bitch.
So what I would say is,
Listen here,
we
you
do not
fucking
think we're
bastard.
behind. We do not think
Oh,
we think
man.
this is timely, but I think you can take this as a sign of our commitment not to get behind. So
Felix
it's
angry after that.
Your other question was,
Is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
so I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case.
He is saying base case.
Cause us to go faster or slower, but that's what the base case says.
In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
What Fix is doing.
In the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know,
They did
the
crash.
shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby. Thank you, Colby Smith with the Financial Times. I'm just following up on Gina's question on rising unemployment. Is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching.
What up, Marlon?
By many other measures, the labor market has returned to or below.
Yeah, good job getting done early and getting out. That's the move right there. Absolutely.
2018.
Definitely don't want to get caught in this craziness.
Bears close watching, and we'll be giving it that.
I'm not in a position right now, but this just looks like frustration right here. Especially if you're in the same day or 1 day expiration. Just chopping.
And that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, we're bears watching, and we're watching.
Just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So that's, our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're
Good
not
question.
seeing rising layoffs. We're not seeing that. And we're not hearing that from companies that that's something that's getting ready to happen. We're not waiting for that because, there is thinking that the time to support the labor market is when it's strong and not when you begin to see the layoffs. There's some lore on that. So that's the situation.
Some
We're-
lore,
we
he
have,
says.
In fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
We're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We are we have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy we think is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with this inflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one, probably. You're at 4.2%. That's, I know that's higher than we were.
Say something good, pal. Come on.
And even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be their wage increases, rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. So we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person. As measured, it's now around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get we get a second jobs report on the day of the meeting. I think no on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Alrighty.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates, and it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me, and that the neutral rate is probably significantly
coming
higher
up on
than
support.
then. How high is it? I just don't think we know. We only know it by its works.
And one more, how do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential.
I guess ask these questions every time.
The Fed, and it's always the same. We're always
The same
always
damn
going into
question.
this meeting in particular, and asking what's the right thing to do for the people.
It's just weird when you're writing down like the questions you want to ask him.
We make a decision as a
You write that down and think, wow, this
we
is
announce it, and
a great question. He's going to give the same answers over and over.
Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part, with a lag. So, nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. If we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop, and so we just don't do that.
Jolene.
Oh,
Thank you.
pull back.
Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that
Historically,
the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time, and the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy, and we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation,
that'd be cool if that's
inflation.
they declared it like that.
Inflation moved down to 2%.
On this day, I declare, I do declare.
We're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not doing, we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing
well. That's not what we want to hear.
Which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe.
That pesky housing.
I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look. When at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? We knew it's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth. Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say.
Yeah.
And from our standpoint, I can't really speak to mortgage rates. I will say, that will depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message?
You don't say.
Illustrated that home prices have still stayed so high as rates have been high. What do you say to those households?
Well, what I can say to the public is that
Sorry.
we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable.
What's inflation?
Restoring that. So what we're going
That's his
through
pipe
now
dream.
really
Just want people to forget what inflation is.
benefit people over a longer period of time.
Funny.
price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with
That it's
inflation.
stable.
That's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people
If you're trading in this,
high prices as opposed to high inflation.
best of luck to you. This is just not good. Oh, lots of questions.
Enter Greg Robb from MarketWatch.com. I was wondering if
Market Watch.
you said just at the beginning that coming into the blackout, there was like an
Are we gonna get a little reversal?
25 or 50.
A little pop back up to
that could move you to
565.
25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, would you have cut rates
Class clown, huh?
50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday, after the CPI number?
Let's pick an option to watch.
Probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Thank you, Chair Powell. Simon Urbanovich, The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions.
Oh, there's 13 left. Oh, there he goes. Oh, you could just feel that volatility coming.
4.4 basically being the peak in the cycle. Would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line.
Oh man, this contracts are ripping.
Of course, but there isn't a single statistic or a single
6 to 9. That's 50%, folks.
that might move that
In what, 10 seconds?
One thing or another. We'll look at each meeting. We'll look at
Pull that back up.
data on inflation, economic
Nice
activity,
pop.
and the labor market, and we'll make decisions about is our.
And as you saw, there was only 13 left on the book at $6.
Medium term.
So if you wanted to get real risky and wild with it, you could have bought all 13 and then push the book over yourself, which obviously there's risk to that. And it's less risky with a 1 day till expire, but you can move the book yourself. It's kind of weird. I've done it with one on the book many times.
And nothing else factors in. But sitting U.S. president should have a say in Fed decisions on interest rates, because that's something that former President Trump, who obviously points of view, has previously suggested. And I know the Fed is designed to be independent, but
I have no idea what
do that so
thanks.
Sure. So
What Powell's like political side is, but that's the way it should be. Honestly, I don't. If he's out there on Twitter talking about who he's voting for, I don't want to hear that. That's not good.
Found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office.
Fortune favors the bold.
That's the idea. Is that and I think that.
Ooh, we might be pulling back. Watch this. It's the 15-second chart right here. Getting out of 9 would have been the move. Nice and quick. My favorite trades are less than a minute. Just wait for that opportune time. Wait for that resistance to break. Pop through. It could be a little false break. And it also could have been a time where you could add to your position if you wanted to build in.
It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chairman
Dynamite.
outlined his views
Nice.
on the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on those changes should be, if those have support
Pull back.
on board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators. You know what? Hold the second question. Let me.
Yeah, I had lost. I'm lost. I don't know what he was saying.
Yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support. That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year. And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger? I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer, for the last question. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. We now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Vulnerable to a shock now that could tip it into recession.
I don't think so.
Man, this lady is asking for problems.
This way, I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
You know what time it is. Well, that's it, I guess, right? That's a wrap. The event has now ended. So, 50 points. Okay, we're done. 50 points. Looks like we got through that whole meeting. And somehow this leaf blower is on again. So here we are back to full screen. Let's see how SPY plays around for a little bit. Looks like it wants to pull back. Just might. Come back down to support. Pretty good chance of that. This is not ideal price action. If you're new to trading, I hope this wasn't your first day. Volatile and choppy. Tough place to be. What you want is nice, clean trends. So coming up here on support again. Are we going to break through, come back down, retest low a day? We just may. What do you say? Can live in a boat down by the bay? Can eat some hay? Lose my mind. Alright, I was trying to trade on my phone, but it just is so hard. So we'll see if support breaks here, but it is coming up on support. Bouncing around. Alright, did support hold? That is the question. You know, I think the meeting went pretty good. Thoughts on Jerome? He held himself well. I've watched many of these meetings now, probably, I don't know, maybe 40, 50. So many. I've been watching him pretty consistently for 4 or 5 years, so probably 5 years. Before the old C word. So coming up again on support, what is gonna happen? Market is basically doing what I didn't want it to do. Like I said earlier, I thought this might be the most exciting part of the day, and we might chop around in the zone in between. And hey, look where we are, chopping around. Still got a little bit of time left on the day, but you know, when you're trading small account options, this is the best time to trade is probably in the morning. It gives you more time to wait for that trend and to ride that trend out. Whereas if you just catch part of a move in the day, it's not going to be as beneficial. Also, it's more risky because all these contracts that aren't in the money are going to expire worthless. So it is exciting, but just be aware of what you're working with here. So this 568 call now $7-8. Remember, just not long ago, the 574 calls we were looking at, those were running back down to 1. All of these 1. So not surprising to say the least. Starting to move, starting to move. Seems so quiet now that I don't have a video playing. Pressure's on. Whoa. So yeah, this contract moving. I mean, now it's already 11, 12. This would have been a good entry. Unfortunately, I didn't hop in, but maybe some of you guys watching did. Or maybe if you're watching the playback, you know, it's just good to know. So 568 calls, just bouncing around. They hit a low of 5, and then as you saw, they just hit 10, 11. So you could have doubled up your money right there in a very short time. I mean, 1 minute. Ran 100% in 1 minute. And they tell you can't trade with $10, $5. I mean, obviously, I have a playlist where I did it with 8, but you know, I know a lot of people are new that watch this as YouTube spreads out the algorithm, which reminds me, please smash that like button if you haven't already. I greatly appreciate you. And I stream every day now. It's been a week so far, but my goal is always to stream for, you know, for Power Hour, or if there's events like FOMC, I'm trying to be there for that. And with each event, you know, I'm just trying to get better, get a little bit more organized. But you know, overall, I say it went pretty well today. I was able to pull up this sheet and look at the numbers. Not able to read them quickly, but what are you gonna do? One step at a time. So SPY bouncing around here. We'll see what happens. Coming back up on that resistance, sorry, around 565, which is a pretty key level. You know, prior to today, 565.15 was the high day. So that is going to remain a key level forever. All right. You know what? Speaking of forever, that's a quote from Sandlot, but I didn't know that that Darth Vader was the guy from Sandlot. Did not know that. the scary guy. Loved that movie growing up. Those were my prime baseball days, man. I used to love playing baseball. I still would, but you grow up, it's hard to find the time. So, enjoy being a kid, man. Goes too quick. So, 565 proven as resistance. Let's see if we can break through here. And let's just take a look at these options again. 560. Look at the 568 now. $22. 22. That thing is ran now what, 400%? Oh, this ain't it. There you go. 400%. This contract just ran while I was running my mouth. Because I still working on that skill of talking and trading. And that's the power of options and trading end of day, same day till expire. Those things can run. 25 now. Man, see, now I have FOMO. I should have just got in. But it was didn't happen. So here we are. This thing is all now up about 500% from 5 all the way to 27. I'm trying to get it to pull up over here, but it's just not pulling. There it is. So yeah, you guys saw it. You could have bought this for $6 5 minutes ago. And now, if you bought just a few of them, you could have take profit on 2 of them after 100% and just let that all be house money, man. Let that run. So that's a great setup. Do wish I would have caught it. Um, but I didn't. So we still have a half hour, and now Webull, they weren't allowing people to trade same day till expire past 5 o'clock. My gosh. I'm sorry. Past 12:15. I already know where the 5 came from in my head. But they might have changed it recently. I actually had an order that went through the other day that was I think it was around 12:30 or so. So I was going to test that out again. This would have been a great opportunity. So we'll see. We might get a nice pullback. Could be a nice setup for a move to the downside. But we could also be setting up for that revisit back to 468. So, and if that's the case, this this contract's gonna run huge. This thing will be oh, nice pullback. All right, so this is a good time to start looking where your budget's at. Um, can I move this out of screen? If I move it behind my head, does that work? Why does this feel so risky? I'm just trying to log in. All right. Okay. We are in, folks, and I missed I missed the setup I was looking for. I wanted to get in at 6. I don't like it as much at this price, to be honest. Now, let's see how strong the market is though, because these 570s that are only $4, this thing pops soon. This could definitely run from 4 to 15 or so on. But again, be careful. That's all I ask. Just be careful. Risky business. Oh, great. Now my computer's about to die. This is the longest stream, so if you guys have been here for 30% of it, thank you. I know people come in and out, especially for something going on this long, so truly appreciate all of you guys watching. And my computer is going to die soon, so we'll see how this plays out. If it doesn't make a move soon, I might just be done for the day. Just walk away with no trade, and then I'll just come back and try to make a nice live trade tomorrow. And maybe I'll come on earlier. We'll see. The plan is still for power hour, but I would like to come trade a little bit earlier to catch some of those moves that I prefer. Because what happens is I end up trading, off stream because I see the setups that I like and what works best for me, and then I end up, you know, using up my buying power. So I'm trying to save it for the stream. And then I can do the recap and everything. So I know a lot of you guys have wanted those small count challenges, and $10 is aggressive. So I wouldn't recommend starting at 10. 20 will give you more breathing room because really I'm gonna make 1 to 2 trades a day. If I would have just caught that $6 one, that would have been a great start. Six, even taking profit at 15 or 20. That's a huge move for the account. Would have been 100% gain or something. But it's all part of the process. Just be patient. The more you rush it, the more you're gonna struggle, and you don't want to catch yourself revenge trading or anything like that. So just be patient. Wait for those setups, and this resistance is why I didn't chase it after I didn't get in at that price, because I could have got in. Was it the 570? I want to say it was 569. Maybe it was the 570. But as you can see, things are losing value pretty quick. The 568 now back to 910 after this ran from 6 to almost 30 in 5 minutes. So it can get pretty nasty. And also, the last 10 minutes of the day can tend to be a time where you see a lot of volume pour in, and you'll see contracts do just crazy things. So don't trade those moments with money that you're not willing to lose. Now, what is my battery even at? 8%, you guys. I'm working with 8% battery right now. Oh man. That's not great. That's certainly not great. So let's take a look at the 569s. What I'm probably gonna just killing my computer. Luckily, I still have my iPad and phone, so if I get stuck in a trade, I'm not completely screwed, because nothing worse than that, or when the internet crashes. Curse you, Comcast. Sometimes it will go out and it just totally ruins the whole network all over, which happens twice a year or so. So that happens on stream sometime. Don't be surprised. Pulling back, pulling back. This is why you don't chase, you guys. This is natural resistance. Making lower highs as it's coming down. Now let's see how it reacts here. Again, this is the 15-second chart, so you're getting a lot of information right here. So don't get lost in the sauce. You want to look at something more like the 1 to 15 minute chart while you're day trading, and the 15-second chart can just kind of give you a little bit of an edge, as well as the order book. If you're watching a contract, keep your eyes on the order book, keep your eyes on the prize, keep your eyes on the ball, and keep your eyes on the order book. Those are the 3 rules in life, I believe. With those 3 rules in life, you shall succeed. Um, Not bad. I'll take that. Maybe I should write that down. Probably won't. So here we are, and I am almost out of battery, chopping around like I didn't want to happen the last half-hour day. Very risky time to trade. Hitting resistance, once it comes back down to here, might be a good buying opportunity if the support does choose to hold. But if it doesn't, let's just think about the other side here. It's always good to have a plan for both sides, up and down. And a big part of this chop is us just filling in the gap from the other day. So that is a little annoying. If you look at the 5 minute, it'll probably look a little bit more gappy. So this whole area where it's just barcoding, this is where the gap is, from 563.80 to approximately 562.80-ish. That is why we're seeing so much freaking chop in that zone. So if I move these alerts, kind of set that bracket. Now it is a volatile day, so it has been bouncing in and out of that range. But as you can see, that's kind of where it chose to bounce around at, and that is not a coincidence. It is because of this gap. Now, if you're trading this day, would have been a great gap fill trading day. Perfect setup. Moved up to the upside, rejected, came back down here to support, once it's looking like it's going to break this level of support, you saw that big red candle, and then following that gap fill. So this would be a case where I would be extra aggressive, move my stop losses even further out. That way you can, wait for this gap to fill. And keep in mind, they don't always fill. Sometimes they like to get real close and then reverse. So, just use it as another tool. So zooming back into the 1 minute chart, just bouncing around. I'm not too enticed by this price action. Looking at the 5 minute chart over here on Meta, Google, Nvidia, Tesla, Apple, Microsoft. And I feel like I'm forgetting one. I often will fill them in and out. And let's check the battery. I feel like that's relevant. 4%. 4%. Oh man. So I think I am just, oh, we might get that reversal. Oh, I'm gonna be pissed if it dies and I make a trade and it's just a beautiful trade. I guess I wouldn't be that pissed. I'd still be happy. Could still show you guys the move. But my plan for the future when I do the challenge is just to review it like I've always done, but do it live and then I'll clip those out. So for you guys that aren't watching the live streams, you can still catch that, 10 to 20 minute segment. And that's my plan. Stan. Hopefully that leaf blower in the background isn't too loud, but you know, I guess it's that time of day where I have to wrap this up anyway. So again, thank you guys so much for coming by. I greatly appreciate it. I was trying to make a nice options trade, but unfortunately I didn't get into that one, but we did watch it move nice. So if you were following along, it would have been a great chance for some of you guys to get set up for that opportunity. So look out for lots more of those in the future and just moves like that. Lots of options and futures trading. Market talk, whether it's market talk or not, I plan on rambling off and kind of getting more random towards the end of the day stream. As people, want to talk about other stuff, stick around, and then people who are here for the market just kind of fade out, and we can just kind of chill. So, anyways, that's what I have for the day. I hope you guys are stay happy and healthy, and I'll see you tomorrow.